Hello, everyone, and welcome. My name is John Harkins. I'm the Events Associate for the French American Chamber of Commerce, New York chapter, and we are happy to welcome you to our webinar today, Increasing Cash Flow Through the R&D Tax Credit. Just a very quick word about our organization before we get into things. The French American Chamber of Commerce's mission is to provide the opportunities, experiences, and understanding that empower successful business relationships between and for members. The FACC New York chapter counts a mosaic of 1,000 members, representing sectors from tech to food, finance, and other professional services. These members have complimentary access to digital events featuring top industry experts and leaders, as well as personalized member-to-member introductions, access to the FACC member directory, and of course, we'll be able to connect with other member attendees of the webinar. This webinar will last around 45 minutes or so, with time for Q&A at the end. And of course, the webinar will be recorded, so don't worry about missing a thing. Just quickly onto our topic and speaker. As businesses look to mitigate the current economic challenges, clarity is needed on the tax credits available to businesses that can help to improve cash flow. To lend insight into how companies from any industry can benefit from the research and development tax credit, we welcome Mr. Thomas Folsom, Managing Director of Ayming USA. Mr. Folsom joined Ayming in 2019, bringing to the company his 15 years experience working across tax litigation, tax controversy, and R&D tax credit qualification and quantification. He is specialized in the application of R&D law for any company regardless of size or industry, having managed and implemented hundreds of R&D tax credit studies, as well as R&D state and federal audits, many through conference appeals. I won't keep us waiting any longer, so Thomas, would you like to take it over?
Sure, thank you very much. Good morning, good afternoon. I understand we have some folks joining us from different places, so thank you for joining us. Like my introduction, my name is Thomas Folsom, and I'm going to go through various aspects, give some color commentary perhaps about my own experience and activities in the R&D realm, and explain how you can hopefully find some cash through research credit here in the US. I work, as you heard, for Ayming Global. I'm the Managing Director of Ayming USA. And Ayming is an international company based in Paris, France. We've been around now for close to 35 years. We've had more than 20,000 clients, and as you'll see, our bread and butter is quantifying and qualifying research credits for corporations. Next slide, please. We here are based in Houston, Texas, so I'm coming to you live from my office. I'm sure a lot of you are at home. In order to eliminate some of the disturbances, barking dogs and such, children, I made my way to the office today, even though it is quite an interesting atmosphere here in Houston with the COVID-19 virus. We are based in Houston, as you see there, but we can travel anywhere in the United States for our US activities. US R&D tax credits. So what is it? What does it mean? Well, first of all, let's give a little background. The research credit was initially established in 1981 in the Reagan administration through the Economic Recovery Act of 1981. At the time, we were coming out of an economic downturn, as some of you may or may not recall or have learned. And the government was trying to incentivize innovation so that we could compete with competitors. Particularly, one example was the Japanese automakers were coming into the United States very, very strong. And the US was looking for something to help our auto industry as well as other industries move along in innovation and spur the economy. It is considered a jobs credit. The idea is that you can claim this credit for the activities that your employees are doing. So instead of taking their salaries as a deduction, you can take it as a credit. And I'll explain a little more about that. Most recently, at least for IRS Statistics, $11 billion was claimed. These statistics, the IRS is slow to post, so these are from 2013 actually. The actual number is today believed to be more around 20 billion. The good thing is there's no limit to this funding, unlike you may have recently heard from the recent acts for the PPP loan or others that have run out of funding. There is no limit to the research credit. So you can build that credit and reduce your taxes. The program helps companies remain competitive by allowing the reduction of the federal and state income taxes. So there are 30+ states that have a state research credit. And the goal is to encourage American business to invest in research and development activities. And if you think about it, the more research we do, we develop new products, companies sell more products, consumers purchase new products, we benefit from new products and new ideas. The companies benefit from income, which they can then hire more engineers and so on and so forth. So it's a cycle. That's what we're looking for. Next slide, please. Again, as I mentioned, it started in 1981. It's been changed various times from the code itself, the regulations that explain how it works, as well as case law. Recently, the FACC Act made the program permanent. I'll explain in just a moment why that's important. And then the TCJA Act eliminated alternative minimum tax for 2018 and forward. Prior to that, the credit could reduce your regular tax liability. It could not reduce your alternative minimum tax. If folks have questions about the difference in those two, it's probably another subject. It gets a little difficult. And I don't have examples to show, but I can certainly answer that at a later time if you have questions. There are 3 significant program changes. Again, it's permanent now, so companies can more aptly plan for the incentive to be in their budget, as opposed to previous when it wasn't clear whether or not it was going to be available or not. There are some benefits that were added. For example, the small business aspect. So companies with less than 50 million in credits, less than 50 million in gross receipts can apply their credits towards AMT as well as regular tax liability. And most recently, startup companies that are within their first 5 years of revenue, reported revenue, can offset their payroll taxes as well as their income taxes with the credit. So some good things to come. Next slide, please. This is an interesting statistic I thought I'd mention. There are, as of 2013, again, because these are the most recent statistics available on the IRS, there's an estimated 6 million eligible companies for the credit, with less than 20,000 companies actually claiming this credit. There's different reasons for that. Next slide, please. Partly because there is some myths and some reality. There is also, well, just an example. I've spoken to my clients when we're talking to them about, well, do you take the research credit? And well, I talked to my CPA and there isn't a research credit. Well, that's because they did talk to their CPA and they talked to them, you know, a year ago or 2 years ago, and it had not been made permanent. The credit had lapsed, and at the time there wasn't a credit. So no, you couldn't take a credit. And then people have other things on their mind and they don't inquire again. So they just assume that it's not existing. So that's one reason why I think the credit's been around for so long, and yet many people don't take it, because at various times, every 2 years, the credit would lapse and then not be available. And so now it's permanent, and I think there'll be some traction for folks who regularly claim the credit. So other things, folks don't think they're conducting quote unquote research. Many believe that you must have taxable income to claim the credit. You can claim it even if you don't have taxable income. You may not be able to use it that year, but you can carry it forward for up to 20 years. So maybe not this year would the credit benefit you directly, but you carry it forward to next year, or you can even carry it back 1 year and reduce and request a refund from prior year taxes. Some folks think it's too complicated, takes too much time. That's where the experts come in. They help you figure it out. They think it's going to disrupt their day-to-day. Again, if you're working with experts, they can minimize that aspect. And I've had few clients who, at the end of the day, they believe that the cost-benefit analysis for the time that was involved was not positive. In fact, most will come back and tell me that, by the great majority, most will tell me that the cost benefit, they couldn't have brought that kind of value for the same cost, the same amount of time for those individuals that were involved. And then lastly, one of the things we regularly hear is, well, we don't maintain the right kind of documentation. For example, we don't have timesheets, so we don't qualify. That's not true. A couple of states maybe, but not for the federal incentive. So no timesheets, no specific documentation required. Our experts will actually work with your team to determine what documents you have on hand and identify those documents, just the things that your individuals keep on a day-to-day basis, and we'll help you collect those and identify them for future as well as prior years so that you can claim the credit. And then, of course, one of the other aspects is what I mentioned earlier, the eligible small business or the qualified small business. If you don't have taxable income, particularly startups, right? Because your expenses are typically high and gross revenue may not be very much, particularly taxable income after expenses may not be very high, but you can definitely offset your payroll tax now if you are a qualified small business. Next page, please. So let's get a little more detail for that. For a qualified small business, or a QSB, it means that you have less than $5 million in gross receipts in the current year, or the year that you want to claim the credit. It also, in order to be a qualified small business, you have to have had less than 5 years of reported gross revenue. So reported revenue, excuse me. So right now, what that means is even $1, if you reported $1 of revenue in 2017 and we're sitting here in 2020, then your company, for the purposes of this, is at least 3 years old. That being said, if you haven't been claiming the credit until today, you would have 2019, your current filing year, and the next 2 years to claim this payroll tax offset. There is not a de minimis rule here, so that's why I say even $1. So it's very important, number one, to look at that aspect and determine if you potentially are a startup company. The second thing that's really important, and time is of the essence, is if you meet that first criteria, then you only have those 5 years to claim the credit, and it can only be claimed on an original return in order to use it for the payroll tax offset. You could go back and file some amended returns and claim the credit and carry them forward to future years for reducing your future taxable liability for income tax, but you would only be able to claim your current year and the next 2 years in our example to reduce your payroll taxes, because again, you can't claim the payroll tax deduction from credits that were claimed on an amended return. So that's a nuance. It's time is of the essence rule, if you will. One thing I'll mention here is there is actually a proposal that is in front of the House right now. It was first proposed, I believe, back in January. I don't know how far it will get. It is a portion of what's called the Forward Act, which has a lot of other aspects included in it. But the good news is the proposal in the Forward Act regarding the research credit is to, one, install a de minimis rule in which you could report up to $25,000 in revenue before your 5-year ticker starts counting down. It would also expand from the $250,000 payroll tax limitation to $500,000, and it would increase the time frame from 5 years to 8 years once the clock starts ticking from your revenue reporting. And finally, it would also increase the gross revenue that the size of the gross revenue. So right now it's 5 million. It would increase that to 20 million. So some significant increases. If this is something that could benefit you, perhaps you might want to take a read. If you just Google Forward Act and research credit, I'm sure you can find it. And then give a call to your local federal U.S. congressman or U.S. senator and tell them you're in favor of it. So again, just to repeat, right now, the qualified small business is eligible for $250,000 in payroll tax offset on a go-forward basis. If you have less than $250,000 in payroll tax, or you have more than $250,000 in credits, you can carry those credits forward. If those carry forward credits are from one of the 5 years, they can reduce payroll tax in future years when you carry them forward. If they once they are outside of the 5 years, then it would reduce your taxable income. And the good news is you can reduce with the credits from the 5-year period, you can reduce payroll taxes and income taxes in those 5 years as well as in the future. So it's a very nice benefit for startup companies. Next page, please. So this is going back a few years for most at this point, because AMT, or alternative minimum tax, was eliminated. But for corporations, for pass-through entities, for example, S corps, LLCs, and partnerships who have high income earners on those corporations that still are subject to AMT, the rule for eligible small business would still apply, and any alternative minimum tax attributable to the company that is also developing the research credit would be eligible for reduction by that research credit. That's a mouthful, I know. So the PATH Act eliminated AMT for businesses. It did not eliminate AMT for individuals. So for those that own what's called a pass-through entity, again, an S corp, a partnership, or an LLC, and they are high income earners from those respective type of companies, then the eligible small business application is still applicable. You can reduce alternative minimum tax as well as tentative minimum tax. Again, the requirements for that, less than $50 million in gross revenue for the prior 3-year average, and can't be publicly traded, so small business for sure. Next slide, please. So I've been talking about this dirty word, alternative minimum tax, or dirty phrase. Let's explain it a little bit. It's often misunderstood. So alternative minimum tax was installed, I believe, back in the 60s by Congress. And it was the idea that individuals and corporations could use their deductions to reduce their income tax to very low or even to nothing. So what the government did was install this idea of an alternative calculation. And what that how that calculation worked, just in a nutshell, is if once you had a certain level of income, then you were subjected to an alternative tax calculation. If you are subjected to AMT, it's calculated, if you will, in the background. So if you're using, for example, an online tax program like TurboTax or H&R Block, even for individuals, this AMT, it's being calculated in the background. And at the same time, you're taking your deductions on your regular tax. So you add in all the things that are deductible. And if you reduce your regular tax liability through your deductions below your alternative minimum tax amount, then you have to pay alternative minimum tax, which cannot be reduced by those deductions. So hopefully that was a good enough explanation of alternative minimum tax so that we can now move into how does this eligible small business on the research credit work. Well, the research credit can only reduce regular tax, regular income tax, I should say. It cannot reduce alternative minimum income tax. So what they did was, back in the 60s, when they put in this AMT, there were a set of tables, and as you can imagine, 40 years later, 50 years later, inflation, there are many more people and corporations that, because of inflation, now their revenue is putting them into alternative minimum tax. So they adjusted the tables several times, and finally they decided that there were too many small companies that should be getting this great benefit, the research tax credit, but they couldn't because they were paying alternative minimum tax, and so the credit just got carried forward. So they put in this eligible small business. And the way it works is you can reduce your regular tax and your alternative minimum tax all the way down to what is known as the 25-25 rule. And if you see there on our picture there, the effect of the ESB rule, had you been a small business prior to the eligible small business rule, you would have been paying alternative minimum tax of, looks about $55,000. But because of the eligible small business rule, you're only paying, which looks like about $2,000, because the research credit reduced not only your regular tax, but your alternative minimum tax down to the effect of what's called the 25-25 rule. So there's an example there. A taxpayer with $200,000 in taxable income qualified for $40,000 R&D credit. prior to ESB, the credit could not benefit the taxpayer. Using the 25-25 rule, it almost entirely wipes out the tax liability. So it can be a huge benefit to a small company. I worked with companies for years that were limited by AMT, and we would do a feasibility analysis each year and determine whether or not they were eligible. And it was almost sad to see these companies who had engineers or software developers or all kinds of professionals that were developing amazing products and processes, techniques, new things for the world to see and use and that improve our lives, and yet they were not eligible for this credit because of AMT. Subsequent to the eligible small business rule, I would visit with my clients, and they would come back and say amazing things about what they had done with the additional funding from the research credit, whether it was building a new lab or hiring new employees. They were definitely applying these tax savings in the spirit and the policy behind the research credit, and it was nice to see. Let's go ahead to the next slide. So there's different ways to claim the benefits. As you heard me mention, companies can claim obviously this year. Right now, the extension filing deadline due to COVID virus was moved from March 15th to July 15th. And then final filing deadline, if you file an extension on the 15th of July, is October 15th, which, by the way, I've heard in the news recently that those may be extended, at least the July 15th one, for certain areas at a minimum. So little information outside of the standard. So the companies can obviously claim it on their current return, as I mentioned. The really nice thing is companies can claim at least 3 prior years. So if you qualified for the credit and you didn't claim it, or maybe you claimed it, but you only claimed a small amount, or you just weren't sure what all could be included. So you went ahead and filed what you thought and moved ahead. You can actually go back and recalculate the credit and file an amended return and claim those credits and request refunds. So it can be a nice cash infusion for a company to either optimize their credits or claim them anew. And then if you are in a situation where you have more credits than you have tax liability, then you can carry the credits forward to perhaps a better year when you have substantial tax liability, and they can be carried forward for up to 20 years. Typically what you'll find is that there's a feasibility analysis to determine the viability of the credit. Utilization, like I was saying, you may or may not want to calculate credits in a particular year using an expert if, for example, you don't have utilization. So in our circumstance, we will do a feasibility analysis before we really get into the meat of the study, so that we can understand, one, the level of credits available, but two, the usability. So that's a plus for our clients. Once that occurs, if there's utilization and credits, then of course you go into a full-on study. We analyze what is qualified and we quantify it and provide pro forma forms. And then there's a project summary report that is written up that describes everything that was included in the credit, how the calculations occur. It's kind of like a roadmap, if you will. So next slide, please. One thing that our firm has recently done because of opening up of the startup companies and the small business, we have a service line we call Ayming Express, and one of my folks says that it's consultation in hours and credits in a matter of days. That's because we can actually, for startups and small business, it's literally hours of our clients' time, gathering documentation, speaking with our experts, and you have a credit in 3 to 5 days, ready to go on your tax return. So it's an area that we are working because there's so many companies now that are eligible that didn't think they were first eligible, or they didn't think, they didn't know how to calculate it, but they talked to some expert company and they weren't, they didn't have enough credits. So what we've done is streamline this process so that we can offer it to very small companies or startup companies at a equitable price with equitable input. Next slide, please. So let's talk about some real life examples. This was a recent project. You could call it a cosmetic or pharmaceutical manufacturing client, $460,000 in credits. I like to start with this industry because many people understand chemistry. This is basic chemistry, mixing different elements and ingredients to develop a formula to come up with a new product. This is one industry that's been majorly impacted by two things. One is allergens. So removing particular allergens from cosmetics and pharmaceuticals has been a major aspect over the last few years and continues to be, as well as making sure that what types of testing is going on, making sure that there's not any animal cruelty aspects going on. So when you change your test, many times you have to develop a new test. And so there's research involved in developing a new test for your new specimen. So this particular client, we spent 2 days with them on a site visit. We reviewed their new available products that they had developed. It was an interesting client because they actually, if I told you the name, you wouldn't know who they are, because they manufacture for the guys that you see on the shelf at the local pharmacy and at the Macy's and all the department stores. When you walk through all the cosmetic area and you see those name brands, these guys actually manufactured those products and developed them. So even though they manufactured it and developed it for someone else, they still qualified for the credit. That's actually one of the perceived barriers. Some people think, well, we develop a product and we manufacture it for another company and they pay us to do so, so we aren't eligible. Well, that's not always the case. The fact is that we'd have to take a look at your contract with that company and determine whether or not you meet one of the exceptions. And if you do, then you may be eligible, as this taxpayer was, for a substantial amount of credits. Next slide, please. So architecture firm, 50,000 bucks. This was actually a fairly small architecture firm. Some people say, well, how do I qualify? We don't have a product. Well, it's interesting. Everyone has a product. It's just that most people, when they think of a product, they think of something tangible, something they can touch and feel and hold. And in fact, architects as well as engineers do have a product. If it's printed, you can touch and feel and hold, but normally it's just the design that they come up with. It's really amazing. My work in the research credit over the last few years, particularly the last 10 so years, I used to drive around and see particularly like some of these school buildings or some of the high rises in downtown and mid rises, and you're like, why in the world are those windows up there in the corner? Or they're just not symmetrical. And you think, well, it's probably somebody who's trying to design it. Well, I did anyway. Maybe I shouldn't, but I thought they were just trying to put their thumbprint on it. They were trying to make it nice. They were trying to make it their own. Maybe put some artistic element into it. But the fact is, what they're doing is they're making that building more functional than the one they built last time. So they've learned from prior buildings. They have software now that they can model, virtually model the designs and actually figure out where to place a window, for example, so that the light coming through that window, number one, doesn't cause a glare on a teaching surface, for example, if it's a school, or if it's an office building, then they place the window or some shading mechanism on the outside of the window so that it doesn't impede the view of a whiteboard, for example. At the same time, they will model where that window is for where the building is sitting on the land and where the shading naturally occurs from not only trees where the building is going to be completed, mountains perhaps, where the sun is going to cross the sky, and so on and so forth. So it's actually very interesting to see how some of these buildings are designed. One building that I had the fortune of working with was, if anyone is a NFL fan, the University of Phoenix Stadium in Phoenix, Arizona, is actually modeled to where it looks like a cactus from the side, but it looks like a rattlesnake coiled up from above. But the windows on that structure are designed to maximize natural light on the field, on the playing field for football. And that's just one aspect of things that were designed into that building to improve its functionality, but also its performance, in that it increased lighting and reduced mechanical load, i.e. fewer electric lights were used to light the field and fewer air conditioners to cool the building. Next slide, please. So technology business, that's most people, they think that they are doing R&D, but well, maybe again, they're doing it for somebody else. This was a small company. They actually received the payroll tax offset. Very new, obviously a startup if it was receiving the payroll tax offset. We spent very little time with the client. I think the client, total time with this client was somewhere around 16 hours is what our client reported back to us that they had spent on this project. So interesting software development. So it can be software, it can also be mechanical when you're talking about technology. So, but nice credits for a small company, 55,000. Next slide. I guess that brings us to the end. One thing that I would say, another example that I always like to give is similar to pharmaceuticals, the food industry. So think about everything you see on the shelf when you go to the market. A simple example that most of us are familiar with is salad dressing, removing the allergens from the salad dressing. the recipe, if you will, is a formula, not only for the salad dressing itself, but how they make it, the process. And developing those aspects are all qualified activities. So many industries can qualify.
Thank you, Thomas. We're almost a minute away from being out of time, but I just wanted to ask a quick question.
Sure.
So you had mentioned the requirements for the small business aspect of this. How often do these small businesses who happen to meet the requirements get rejected from the credit?
That's a good question. I don't know because it's not reported. What I can tell you is to claim the credit, all you do is you calculate it and you place it on your tax return and it reduces your taxes. And so from there, the only way it would be rejected is if you were audited. So what I can tell you is for original claims, less than 4% of original claims are audited. So that's all returns. So even fewer of those are claiming research credit. So the percentage is very, very low, very low. That's the best I can do to answer that question. Rejection, our way of claiming credits is different than most other countries. Most countries, they submit a claim for it and it's audited immediately. Ours aren't, typically are not audited, and so they're typically not rejected.
Sure. Well, I know that some people are trying to ask questions as we end, but unfortunately we have run out of our time here with Thomas. I just would like to reiterate that this recording will be available to all attendees, as will the slides, which, as you can see here, include Thomas's contact information. So if you have any questions directly for him, feel free to contact. He's been kind to provide that. To our network in the FACC, I just want to point out that we have another webinar next week on digital innovation for financial services. And we also are launching our podcast initiative on innovation within our membership base. Thomas, I just want to say thank you once more. Really appreciate you going through all of this and enlightening us as far as something that wasn't really well known. So we very much appreciate it. Thank you so much for coming on.
Thank you for having me, and thank you to those that attended. And like we said, you're welcome to contact me.
Great. Well, thank you to all attendees. Looking forward to seeing you at our next webinar. Have a great rest of the day to everybody, and take care.